Maximizing Price Stability in a Monetary Economy by Warren Mosler and Damiano, Silipo. Section 4. Current Policy. For all practical purposes, the euro uses unemployment, a measure of the output gap, as a buffer stock to promote price stability, enacting policy designed to increase unemployment, the size of the buffer stock of unemployed, when inflation is deemed to be too high, and enacting policy to decrease unemployment when higher rates of inflation are desired. Specifically, the ECB uses its policy tools to indirectly promote alterations in the unemployment rate for the further purpose of promoting price stability. The theory is that of the Phillips curve, where inflation is a function of the level of unemployment, with lower unemployment an inflationary bias and higher unemployment a deflationary bias. It is further assumed that the curve shifts both in slope and along the y-axis with alterations to the institutional structure. Furthermore, a NIRU is presumed, where inflation accelerates when unemployment goes below that point. This acceleration is presumably caused by accelerating inflation expectations triggered by the low rate of unemployment, which triggers the two primary drivers of inflation expectations: demand for higher wages, and accelerated spending. Figure 4 is a typical Phillips curve. ECB policy initiatives are designed to shift the economy's position on the curve, while other government policies, such as what are called structural reforms, along with demographic changes, work to shift the curve. So while the policy instrument is the term structure of interest rates, the cause of inflation is inflation expectations, which can be altered directly by the influence of interest rate policy as well as by the influence of the level of unemployment on inflation expectations. The monetary link between interest rates and unemployment is through credit channels. Higher rates are presumed to reduce the desire and ability to borrow to spend on real goods and services for both consumption and investment, thereby reducing sales, output, and employment. Conversely, lower rates are presumed to increase desires to borrow, thereby increasing sales, output, and employment. In particular, investment has traditionally been assumed to be largely a function of interest rates. Furthermore, the link between interest rate policy and output and employment has been deemed sufficiently robust to the point where its presumed monetary policy can be utilized to sustain desired levels of output and employment, with national governments budgeting fiscal surpluses to reduce their national debts. The last several years have provided substantial empirical evidence with regard to several previously presumed causations. In addition to inflation being less sensitive to changes in output and employment than presumed, the link between interest rates, inflation, investment, output, employment, and even credit expansion itself appears to have been largely severed as well. After over 5 years of a near 0% rate policy, and more recently quantitative easing and negative rates, private sector credit expansion remains depressed and has not been the presumed driver of investment, consumption, or inflation, as the output gap remains alarmingly wide and the monetary system borders on deflation. Along with the exceptional magnitude of the real output loss from what has the appearance of permanently elevated levels unemployment, the political pressure generated by the negative externalities of unemployment have intensified as well. The outcomes of the last several years have also largely obviated the proposals of Blanchard et al. 2013 regarding the expansion of the ECB's mandate, as the evidence calls into question assumptions that the proposed ECB's mandates are a function of its available policy tools. Consequently, the unemployed buffer stock concept per se has become highly problematic. Interest rates were lowered aggressively after credit growth ended. However, credit growth has yet to resume. Unemployment rose as credit expansion ended and remains elevated, and output remains depressed. The sequence of events has been supported very recently by The Economist, 2016. It states that, quote, for all the cheap money, the growth in bank credit has been dismal. Pay deals reflect expectations of endlessly low inflation, which favors that very outcome, end quote.